Hello, everyone. Today we're going to go over a couple key components and indicators that we should really be looking at and some data that we should be looking at to make sure that we have a good understanding of where the market is, where it's going in this environment, and where we're likely headed to over even the next couple months to maybe the next 6 months. So let's get right into it. First things first, looking at the three components that I talk about pretty much every time I give a little bit of a market update here is biggest thing, what's going on with monetary policy, right? We have the stock market back here, or at least the S&P 500, so 500 of the stock market. But then we also back here have the Federal Reserve's balance sheet. So that's how much the Federal Reserve has printed into existence to buy securities or is selling, right? Are they net selling or are they a net buyer, right? But then also we have back here in purple, the reverse repo market. This is a very, very, very important account right now because what the Fed did was they printed a bunch of extra money back here, parked it through the financial system into the reverse repo market to provide liquidity to the treasury market when the federal government spent more money than what is demanded out of the treasury market. So what ended up happening was we've been draining the reverse repo market back here. And what you're going to notice is down here, we have been slowing down and rolling over to where the reverse repo market has, in essence, halted over the last few weeks. Now, this is really important because the last time that we halted for some time here, we ended up starting this correction. And then anytime that the reverse repo market or that there was net tightening, which is the Federal Reserve selling and the reverse repo market not draining, so that would be like this section, right? Basically almost all of this section. So this is the net section of actual tightening, right? So this is the last time that we had actual quantitative tightening going on, and you can see how the markets behaved for that. So what's going to happen here now that we have tightening and the reverse repo market has looked like it is looking like it has stopped right now? That's right. We are moving back into an environment similar to inside this large red box. So more choppiness, increased volatility. We are seeing the transition happening right now. Something to be also said is that last time we entered this kind of weird not QE where the whole market climbed and climbed and climbed forever was actually right here in 2019. Now we did have COVID on the backside of that. So I mean, I know COVID was kind of crazy and pandemic and likely it's not going to happen again and things like that. But one thing that I'm just going to be very clear about is that when the markets get pushed up without a large correction, say something 5% or more in 100 days or so, the markets get really sensitive to the downside. So they just get really slippery is kind of what I call it. So it's just the sell-off can turn into something pretty quick and slice down through quite a bit of technical indicators. And honestly, it wouldn't shock us to come back here to where highs are, where they were previously, or even check back in here on these swings somewhere around here. There is a large gap right here. So something like that really wouldn't shock us too much, but that is a pretty large pullback in that regard. If we turn this back to actual price pattern or price targets, we'd be, what, 4,600 or so on the S&P on the low end, on the slightly higher end, 4,820 or so. So that'd be a pretty large correction that we'd have back here. I don't know if we have it in us to do a full contraction, about 20% of what we had in 2022, but I could be wrong, right? But this is how things are lining up. So looking through what have we done through this environment, I'm also going to go through some projections of what the economics are going to be like here in just a minute, and then I'll look at interest rates and what that's going to look like as well. First, let's go into some adapt daily trades that have been doing really fantastic lately. So if I scroll down here to the end here, you can see that we have recently hit a new high again. So we're up to just about 217,000 in this account. We started out at 100,000 in this account all the way back in February of 2023. So this has been just a little bit over a year now. We've done 116%. And that's been fantastic. Lately, we've been doing a lot of surfs and buoys. So here's a couple buoys that made some money, of surfs that actually lost some money. But then you come down here, and now the surfs are being breadwinners, and then the buoys have kind of reversed. So, anyways, so as you trade for the environment, like we do in the Adapt Daily, you're going to trade between different types of trades. Buoys and surfs have been really, really common in this huge, big run up. But before that, we had a lot of reefs, a lot of no trades in here. We actually took almost a month off. You can see here about 2 weeks off back in December, which was really nice. Just market environment wasn't conducive to anything. Lots of surfs, lots of buoys. And then, of course, in October of last year, we had lots of reefs going on. So reefs are a lot of fun. And the reefs will definitely get some different types of profit targets and things like that whenever they kick on. So that's a little bit up to date. You can see down here on our chart that we did have a little bit of a drawdown back here in February, but we've kicked right out of that and pushed into new highs. Looking awesome, having a good time, and making some money. So it's always nice to hear all the feedback that I've gotten from the members, that they have been matching or beating my results. So if that's you and you're watching this video, awesome. Share it on the forums. Talk to some other people. Tell us your secrets on how you're beating my returns. Of course, it's probably not too much of a secret. You guys know I'm pretty much like a machine. I execute every day near the same time. So if you're a little bit subjective, or if you're going to be a little bit more of an advanced trader, you can of course make quite a bit more money than me if you are timing things well. You don't need to. You can be the machine just like me. All right, let's jump into what is going on over here, which is interest rates, right? This is something that we need to be looking at. So we're going to put together a little bit of a picture here. If we draw a picture, we really need to be looking at, say, let's call it 3 components. So in the first box, we need to know what's going on as far as quantitative easing or quantitative tightening, right? So that's box number 1. This is a very big deal. So right over here, we know net overall, we've been easing since April of last year. And this current time, we are actually quantitative tightening. I know, it's like the first time in a year, almost, I should say, a year, April of last year. So a year that we are actually seeing real quantitative tightening in the financial system. That means downsides are going to be a lot more slippery. That means volatility is going to increase. That means choppiness is going to increase. That means a little bit more chaos. That means the grinding up of infinity low volatility is over officially. Now, I'm calling it. It's just how it is, right? This is the mechanics of the market. Now, also, the second box is we need to know what are interest rates doing. Why do we want to know interest rates? Well, if interest rates start dropping across the board, that acts like an easing. And if it's easing, then that can make up for the quantitative tightening and turn it into somewhat quasi-quantitative easing, right? So that's our second box. And then our third box that we really want to pay attention to is GDP and just general growth in the economy. If we have outright raw growth in the economy, if this is up and these two are down, we can be kind of neutral. But if we end up getting a GDP that's flat and both of these are down, the downside is very slippery, right? So let's just go look at the other components. We know that we're in actual quantitative tightening as of this moment. You know, keep an eye on the reverse repo market and the Fed's balance sheet to know if we're going to be doing anything different, because it can change from one week to the next. Even overnight, you can see the reverse repo market start to drain again, right? So keep an eye on that. But the other two, let's go look at what interest rates and GDP are doing. Interest rates. So overall, it looks like as of May, interest rates are going to hold steady per what's being priced into the market. 93% is going to be at 525, 550, which is exactly where the current rate is right now. Let's look at it. June. Things get a little interesting in June. We are pricing that the majority of the probability is going to stay where the interest rate is at, but we are starting to start showing quite a bit of a probability that there might actually be a rate cut in June. So this would be the first month that we would be seeing a rate cut down to 500 basis points. In July, it's almost guaranteed, or at least mostly it's guaranteed that we're going to be in this 500 to 525 basis points If we didn't get a cut in June, that means we're going to get a cut in July. If we don't get a cut in June, then we will get a cut in July, is what the pricing is looking like. Then if we go down to September, you can see that another rate cut is starting to be priced in down to 475, right? So that's 2 rate cuts over the next quarter. So that's going to be a little bit of somewhat of a stimulus, right? That's if they happen, right? So 2 rate cuts isn't that big of a deal. It's something, but it's not that big of a deal. So net, I'd say a little bit of benefit, but really we're just probably going to be going from a aggressively inverted yield curve to a less inverted yield curve, which still means that it's probably a net tightening effect, right? So that doesn't mean that we're easing. Yes, we can be dropping interest rates, but that isn't easing like what we've been seeing in the quantitative easing side of things with the reverse repo market. So we're straight up actually tightening even with dropping interest rates. So net, we're tightening. Then let's see what's looking out on GDP, because so far our boxes are down because we're doing quantitative tightening, and down with interest rates. Even if they're dropping, there's still an inverted yield curve, which is still a net tightening in that regard, albeit a little bit easing. So we can call this kind of, well, let's just call it a wash for now we will redraw this with an arrow that's kind of sideways. How's that? So we'll call this sideways. So down, sideways. Let's go look at GDP. Let's see what this guy is going to show. All right, so we're just going to go look at the conference board. I've got my own calculations, but I don't really pull those up because I want you guys to be able to just even look for yourself of just something that's publicly available out there. That way you don't have to, there and trust my models or something like that, right? Even though I put a lot of trust in my models. Looking at real GDP, here we go. 2024. What's going to happen in Q2? Well, in general, our real GDP is going to be positive. So you could say, that's great. But we got to keep in mind that the stock market doesn't look for positive and negative. It looks for the overall acceleration or deceleration, right? And this is a big, major deceleration in real GDP, right? This quarter is going down to a 0.5 GDP from a 2.2 that we had in Q1. That's a pretty big deal, right? And we actually had a little bit higher than that per GDP now. So that's a pretty big deal that we're going to have that much of a slowdown. Then on top of that, if you look on a year-over-year basis, so if you're looking at something like a rate of change, right, you can see 2.9, 3.1, 3.1, the next sort 2.7, 1.5, 1.0. So you can see there's a slowdown happening. So we're getting a second slowdown, very similar to what we saw in 2022, but this was a large contraction in GDP. We're likely not going to see something as large, like I said, in 2022, just a small correction and a slowdown in GDP with some tightening from the Fed. So a little bit of slipperiness to the downside, but we're not looking at 20 or 30% to the downside. We're most likely looking for just a correction. So maybe something like 10 to 12% to the downside for the market, which wouldn't be unreasonable at all. And then if they end up printing through the process, or the Fed turns around and starts to print and do quantitative easing or something like that, of course that would change everything, because then now you're changing the variables. But as of right now, this is how we're looking. Also, something that I really want to just talk about that we're seeing here, the last time that real consumer spending was at zero, right, and they projected it out to be zero, that was in Q1 of 2022, and you kind of how the market was during that time period. Yet again, in Q3, we're actually showing real consumer spending down at zero as well, right? So that is something to be said. We are looking to accelerate back in Q4. We'll see if that ends up happening. And so that could be positive, but real disposable income looks like it's going to get pretty much contracted, right? It's not going negative, but it is definitely slowing down, right? So just that slowdown, that deceleration, you can see residential investment slowing down, everything just kind of generally slowing down. Definitely not negative, or at least it's not projected to be negative by these models. Of course, there's always an error, right, when you're trying to project out the future. So just know that there's some pluses and minuses around here. You can also see that the massive amount of government spending that we've been used to is being sucked dry, right? No more crazy. Yes, there is still a lot of government spending, but they're projected to be slowing down on their government spending. That's also something that is attributing to the fact that the reverse repo market isn't draining. Then on top of that, you can see over here that we are rising in unemployment projected out as well. Nothing too crazy. So, like I said, not looking like a full blown out recession craziness, right? We're trying to do this whole soft landing thing. So, just in general, it looks like we're going to get some sort of correction from now till the end of the year. And then probably in Q4 when things try to reaccelerate, right? You get a 1.1. So somewhere around in Q3 should be some really good buying opportunities for the remainder of the year. And that's what my models say as well. They agree with Q4 should be a reacceleration, and it should be actually quite amazing as long as there isn't a huge misstep from the Fed or something else like that. So going back to our little boxes here, right now, in general, we are showing a slowdown in GDP. So if we've got tightening, basically nothing in interest rates, even though they might drop a little bit, and a slowdown in GDP, you will say overall, we definitely have a downside probability, or at least more downside risk in the markets for the next quarter, at least right now. So keep an eye for quantitative easing, quantitative tightening, and they're sneaky. They do it through the reverse repo market right now. But they have also, the Fed just recently talked about the fact that they might be changing their balance sheet. They might actually start to stop this or slow it down because they know that they don't have the room to do it anymore because that reverse repo market is getting close to zero. So we still have 400 billion left in it, but right now it's not being used. So it's just a piggy bank sitting on the sidelines. So they'll have to do something about it, either drop its yield to drain it more into the treasury market, or they'll have to turn around their quantitative tightening. All right, guys. Well, I'll see you next week. Trade well, make a bunch of money.